Level 1. The Reluctant ATM, $1,247. That is your balance. You check it at 11:43 p.m., lying on a mattress that smells like the previous owner's laundry detergent. You check it again at 11:44. The number doesn't change. Your phone buzzes on the nightstand. It's a text from your brother, Marcus. He doesn't ask how your shift went. He asks for $150 for a utility bill. Your jaw tightens. It's the same way your mother's jaw tightened in 1998 when the car made noise. You are 23 years old, and you're doing the quiet arithmetic in your head while the blue light of the screen washes out your face. If you give him the $150, you are buying the store-brand cereal for the next 2 weeks. You are putting the good coffee back. You are shared password tier poor, and Marcus is asking for the air right out of your lungs. You send the money via the app. The interface is colorful and bright, sending a little animation of flying coins as your balance drops to $1,097. The app treats it like a game. For you, it's a life leak. There is no paperwork. There is no interest. There is only the invisible ceiling of family obligation. You aren't a lender here. You are an unpaid insurance policy for someone who refuses to look at their own spreadsheet. You don't talk about it at Sunday dinner. Nobody does. But you feel the weight of that $150 every time he orders a side of fries you skipped. The knife turn. Money is the air. Either you have enough or you're already suffocating, and at this level, you're letting family breathe while you hold your breath. Level 2. The silent creditor. You moved up. You are 28. You have $14,600 in a high-yield account. You feel stable until your sister, Sarah, calls. She doesn't need grocery money. She needs $2,000 for a security deposit because her landlord, Sable, is selling the building. She promises she'll pay you back when her tax return hits in April. You write the check. The treatment here is polite indifference to your own boundaries. You watch the digits on your screen scroll backward. You've graduated from the reluctant ATM to the unpaid creditor. You start noticing things you never used to notice. You see her post a photo of a $14 cocktail on Instagram. You see the new boots. You do the math. Those boots are 3 days of your labor. That cocktail is an hour of your life she hasn't returned to you. This is the status churn. You are working extra shifts to replace the capital you lent while she sleeps soundly. You don't ask for the money back because family doesn't do that. So you pay the social tax in silence. You start avoiding her calls not because you don't love her, but because every conversation feels like a transaction that hasn't cleared. You're lending the bank your patience so they can lend Sarah your stability. The knife turn. The most dangerous part of lending at this level isn't the loss of the principal. It's the silence that grows between you. You realize that salary is a ceiling dressed up as a floor, and your family is the one pulling the floor out from under you. Level 3. The anchor strategy. Your income pattern has changed from irregular to consistent. You have $40,000 saved, and you're starting to believe in the math. Then your cousin, Marcus, calls with a business opportunity. He needs $5,000. He says he's one piece of equipment away from scaling. You aren't just a safety net anymore. You are a viable revenue source. The system of your family notices this. They don't congratulate you on your Roth IRA. They algorithmically adjust their expectations of you. You feel the invisible ceiling. It's the unspoken rule that your progress is collective property. You sit at your laptop at midnight, the screen lighting your face, and you run the numbers. If you lend this $5,000, your own anchor into the market is delayed by 8 months. The treatment here is algorithmic engagement. Marcus isn't asking for help. He's pitching you. He uses the language of investment to mask the reality of a handout. You find yourself speaking to a human being named Run, the internal persona of your growing financial professionalism, who tells you that salary is a ceiling dressed up as a floor. You realize that every dollar you lend to someone who hasn't mastered their own quiet arithmetic is a dollar you're removing from your own foundation. The knife turn. You are at the competence plateau. You're good at surviving the family's emergencies, but you're not yet good at building your own distance. You realize that the most dangerous part isn't the loan itself, but the fact that you're becoming the anchor for everyone else's sinking ship. Level 4. The prime lender. You are 35. You have crossed $150,000 in net worth. You've reached the prime tier of family lending. Your parents need $25,000 to remodel the kitchen or cover a gap in their retirement planning. They don't beg. They consult you. The sensory experience changes. The hold music of your guilt is shorter because you have override authority over your own emotions. Wall Street and your siblings start to treat you with deference. You are offered a Lombard loan of family dynamics. You provide the $25,000 now, and the family understands that this will be deducted from your future inheritance. You are extending credit because the collateral of the family home makes the risk feel manageable. However, the tax of this level is the complexity trap. You start seeing that your money has a personality, and its preference is to stay away from your relatives. You start saying no to the people who knew you when you were doing math in the grocery store line. You realize that talking about money at this level makes people strange. They're either envious or they treat you as a proven asset rather than a person. The knife turn. The shift happens here. You stop spending money to maintain these relationships and start protecting capital to build options. You realize that wealth is not what you accumulate. It's what you no longer have to do, and you no longer have to be the primary financier of a family that refuses to learn the quiet arithmetic. Level 5. The institutional asset. You are 42. Your combined assets have crossed the $1.5 million mark, and your monthly investment capacity has reached a level that most retail banks only see in their nightmares. At this level, lending to families stops being a transaction and becomes a named relationship. You are no longer just a successful relative. You are an accredited asset in the family ecosystem. The interface for these loans is no longer a text message or a phone call. It is a human being named Run. Ren is the internal persona of your legacy, a mental guard who reminds you that you are now a line item in your own life's performance review. When a family member asks for $100,000 to buy into a franchise or settle a messy estate, you don't look at your bank balance. You look at your global financial map. You realize that this capital has a job to do, and lending it at 0% interest is an identity tax you can no longer afford to pay. The treatment here is strategic protection. You start involving professionals to act as a buffer. You tell your brother to talk to my accountant or email my attorney. It sounds cold to them. It sounds like you've changed. In reality, you are just protecting the quiet arithmetic that got you here. You've reached the level where your access is real regardless of the motivation behind it. But you also understand that wealth is not what you accumulate. It's what you no longer have to do, and you no longer have to be the family's primary insurer. The knife turn. You realize that at this altitude, the only thing more expensive than the money you lose is the time you spend explaining why you can't afford to lose it. Level 6. The high net worth consultant. The definition of family help changes texture when you're deploying $500,000 at a time. At this level, you stop being a lender and become a service that comes to them. You aren't just giving money. You are offering the packaged version of financial planning, tax coordination, and estate guidance wrapped into a single, complicated relationship. The conversations change texture. You're no longer being sold on emergencies. You are being consulted. Someone is asking you about your risk tolerance for their failed lifestyle. The family is trying to understand your full financial picture, not because they're altruistic, but because a full picture allows them to capture more of your life under their umbrella. The motivation is commercial. The experience is personalized. Both things are true at the same time. You start to notice the isolation tax. When something goes wrong, and something always eventually goes wrong, the resolution is expected to be faster and more satisfying because your account warrants that level of response. You aren't a cousin anymore. You are a proven asset to the family survival. The language they use with you is different, the protocols are different, and the distance between this and level 2 is not a matter of better service. It is a different institution operating inside the same skin. The knife turn. You learn that the difference between a gift and a loan at this level is purely grammatical. You are not a different person. You're a person whose context has become untranslatable to the people sitting across from you at dinner. Level 7. The capital architect. Above $5 million in personal assets. The way you lend to family begins to involve things that are not publicly advertised. You offer products that don't appear on a standard bank website, bespoke trust agreements, and private credit facilities. The interest rate you charge as sibling for a mortgage is lower than what anyone in level 3 would ever be offered. Not slightly lower, meaningfully lower. The family competes aggressively for your attention because a borrower of your profile is almost no risk to them, but you are a massive risk to yourself. Your advisor, that inner voice, Run, is now a specialist. He coordinates with the estate structures you've built to ensure that helping doesn't trigger a gift tax that would choke a smaller horse. You meet with your relatives in rooms that don't look like the rooms where level 2 customers wait. The rooms have better chairs, and the conversation has different stakes. You get special treatment at this level. That phrase sounds simple. What it actually means is that the rules governing family lending, the waiting periods, the approval timelines, the emotional manipulation apply differently to you. Not because the family is different, but because your internal policies have discretion built in. And that discretion is exercised only in favor of relationships that generate significant peace of mind revenue. The knife turn. You realize that the top isn't about avoiding risk. It's about choosing which family members are worth sitting with while the spread works against them. Level 8. The infinite sovereign. You have reached the final tier. You are an account of significance. Your name is a line item in the family's future, and losing you would be a catastrophic event for their standard of living. At level 8, the credit score of your brother or sister is a historical artifact, a relic of a time when they were vetted by their own potential. The treatment is total sovereignty. You do not have a relationship in the way level 1 understands it. You have a private banker dynamic with your own bloodline. This person, you, manages a small number of relationships, and your entire professional focus is on the reach of that capital. The deals at this level are bespoke. The interest rate is negotiated at a distance, not published at a table. The rules become flexible because the relationship justifies it. The system that was automated and indifferent at level 1, letting Marcus take your last $150 while you stood in a CVS, is now human, attentive, and oriented toward yes. You are not a relative at this level. You are a relationship. The family's connection to you is a named line item in their survival strategy. Losing you would matter to people whose lifestyles depend on not losing you. The final accounting. You look back at that 23-year-old at the CVS. He thinks this is a story about being mean or generous. He doesn't know yet what it will cost, not in dollars, but in distance. In the gap that opens between the person who puts the coffee back and the person who buys the whole shelf. The balance is $1,247. It always starts there. It always will.